Hello, everyone, and welcome back to America Immigration Update, your trusted source for the latest news and important alerts affecting immigrants, international workers, and U.S. residents. Today, we're discussing an important IRS alert for 2026 that could affect millions of people living in the United States. If you have a foreign bank account, savings account, or even a small amount of money held outside the U.S., there is a rule you absolutely must understand. Because according to the latest IRS guidance, failing to report certain foreign financial accounts could lead to penalties of up to $16,536 per violation. And the surprising part is that many people don't even realize they are required to report these accounts. In today's video, we'll explain what the IRS foreign account rule actually is, who must report their accounts, why the penalty can reach $16,536 or more, common mistakes that lead to penalties, and how you can stay compliant and avoid problems with the IRS. So make sure to watch until the end, because this information could help you avoid serious financial trouble in the future. The IRS Foreign Bank Account Rule. Let's begin with the rule itself. The United States government requires certain individuals to report foreign financial accounts through a filing known as the FBAR, which stands for Foreign Bank Account Report. This report is officially called FinCEN Form 114. The rule applies when the total value of your foreign financial accounts exceeds $10,000 at any point during the year. Now, here's something important to understand. The IRS is not looking at each account separately. Instead, they look at the combined total of all your foreign accounts. So, for example, if you have $4,000 in a bank account in India, $3,000 in an account in Mexico, $3,500 in a savings account in Canada, your total foreign accounts equal $10,500, and that means you must file an FBAR report, even if none of those accounts individually exceeds $10,000. This is one of the biggest reasons people accidentally violate this rule. Why the IRS requires this report. Many people wonder why the government asks for this information. The FBAR rule was created to help prevent tax evasion, hidden offshore income, illegal financial activity. Over the past decade, governments around the world have increased cooperation in financial transparency programs. This means many foreign banks now report information to U.S. authorities through systems like FATCA, the Foreign Account Tax Compliance Act. So even if someone believes their account is private overseas, there's a strong chance that financial institutions may already be sharing information with the United States. That's why reporting your accounts correctly is extremely important. Who must follow this rule? Now let's talk about who is required to follow the FBAR rule. This requirement applies to U.S. citizens, green card holders, U.S. tax residents, certain visa holders who meet tax residency rules. It can also apply to business owners with foreign accounts, people with authority over company accounts overseas, individuals who have joint accounts outside the United States, and this is where things sometimes get confusing. Even if the money does not belong entirely to you, you may still have reporting obligations. For example, if your name appears on a foreign account or if you have signature authority, the IRS may still require reporting. The $16,536 penalty explained. Now let's talk about the number that has been getting so much attention recently, the $16,536 penalty. This amount refers to the maximum penalty for a non-willful FBAR violation. In simple terms, this means the IRS believes the person did not intentionally hide the account, but still failed to report it properly. These penalty amounts are adjusted each year for inflation, which is why the figure has increased over time. But that's not the only penalty people should know about. Because if the IRS believes the violation was willful, meaning intentional, the penalties can be much more serious. In those cases, the penalty could reach 50% of the account balance or more than $100,000 per violation. In extreme cases involving tax fraud or criminal activity, additional legal consequences may apply. However, Those cases usually involve deliberate attempts to hide large amounts of money. Why many people accidentally violate this rule? One of the biggest problems with the FBAR rule is that many people simply don't know it exists. Here are some common situations where people accidentally fail to report foreign accounts. First, immigrants who moved to the United States but kept savings accounts in their home country. Second, people who inherited foreign accounts from family members. Third, individuals who opened international investment accounts years ago and forgot about them. And fourth, people who hold accounts jointly with relatives overseas. In many of these cases, there is no intention to hide money, but because the reporting requirement still exists, the IRS may still apply penalties if the account is not reported. How the IRS finds foreign accounts. Some people believe that if their bank account is overseas, the IRS will never find it. But that assumption has become much less accurate in recent years. Today, the United States participates in multiple international information sharing programs. Under FATCA agreements, many foreign financial institutions provide account data connected to U.S. taxpayers. Banks in dozens of countries now report information about accounts held by Americans or U.S. residents. This includes account balances, interest income, ownership information. Because of this, the IRS can often compare foreign bank data with tax filings. If the agency sees accounts reported by banks but not reported by the taxpayer, it may trigger an investigation or compliance review. The important filing deadline. Now let's talk about the filing deadline. The FBAR must typically be filed by April 15th each year. However, there is an automatic extension until October 15th if you miss the April deadline. The report is filed electronically through the Financial Crimes Enforcement Network system, not directly through the IRS tax return. That's another reason people sometimes forget about it, because the FBAR is separate from your regular tax return. What if you already missed the filing requirement? If you discover that you should have reported foreign accounts in previous years, there may still be options available. The government has established certain compliance procedures that allow individuals to correct past mistakes. These programs are generally designed for people who did not intentionally violate the rules. Depending on the situation, individuals may be able to file late reports and explain the reason for the delay. In some cases, penalties may be reduced or waived. However, the details can vary depending on the specific circumstances. Because of this, many people choose to consult a qualified tax professional if they believe they may have missed past reporting requirements. Examples of foreign accounts that must be reported. To help clarify things, here are examples of accounts that may fall under the FBAR reporting rule. Foreign bank savings accounts, foreign checking accounts, investment accounts held overseas, foreign retirement accounts in certain situations, foreign mutual funds, accounts held in foreign financial institutions. It's important to remember that the rule applies to financial accounts, not physical property. So owning a house or land overseas does not trigger FBAR reporting unless there is a financial account connected to it. Steps you can take to stay compliant. Now that we understand the rule, let's talk about some practical steps people can take to stay compliant. First, review any financial accounts you have outside the United States. Second, calculate the highest combined value of those accounts during the year. Third, if the total exceeds $10,000 at any time, prepare to file the FBAR report. Fourth, keep records of account statements and financial activity. And finally, make sure the report is filed before the deadline. These simple steps can help reduce the risk of penalties. Why this matters for immigrants and international families. For many immigrants, maintaining accounts in their home country is completely normal. People often keep funds overseas to support family members or manage property abroad. However, once someone becomes a U.S. tax resident, the reporting rules can change. This is why awareness is so important. Understanding the FBAR rule allows individuals to stay compliant while maintaining legitimate international financial connections. Key takeaways. Let's quickly review the most important points from today's video. If your foreign financial accounts exceed $10,000 combined at any point during the year, you may need to file an FBAR report. Failing to file could lead to penalties of up to $16,536 for non-willful violations, with higher penalties possible for willful violations. The rule applies to U.S. citizens, green card holders, and many U.S. tax residents. And the filing deadline is generally April 15th, with an automatic extension to October 15th. Most importantly, many people violate the rule simply because they don't know about it. That's why staying informed is so valuable. Final thoughts. As international banking becomes more common, the IRS continues to focus on foreign financial reporting compliance. The goal is not to punish ordinary people who maintain legitimate accounts overseas. Instead, the system is designed to promote transparency and ensure accurate reporting. By understanding the rules and filing the required reports, individuals can avoid unnecessary penalties and maintain peace of mind. If you found this update helpful, make sure to subscribe to America Immigration Update for more important alerts about immigration, taxes, and U.S. government policies that may affect your future. And if you know someone who has bank accounts outside the United States, consider sharing this video with them. It could help them avoid costly mistakes. But before we end today's video, there are a few additional points that could be very important for viewers who may currently have foreign financial accounts or are planning to open accounts outside the United States in the future. One important thing to understand is that the FBAR requirement applies even if the account does not generate taxable income. Many people believe that if their foreign account does not earn interest or profit, they do not need to report it. However, that is not always correct. The FBAR requirement is based on the existence and value of the account, not necessarily whether the account generates income. For example, someone might keep money in a savings account overseas simply to support family members or to maintain financial ties with their home country. Even if the account earns very little interest, it may still need to be reported if the combined value of all foreign accounts exceeds the reporting threshold. Another important detail is that digital banking and international financial services are making it easier than ever for people to hold money across different countries. Some individuals may use international online banks, digital wallets, or investment platforms based outside the United States. In some cases, these types of accounts may also fall under foreign financial reporting rules, depending on how the accounts are structured. That is why it's a good idea to keep careful records of any accounts you maintain outside the United States. Keeping documentation such as account statements, balance summaries, and transaction records can make it much easier to complete the reporting process if needed. It is also helpful to review your accounts each year before tax season begins. By checking your foreign accounts early, you can determine whether the combined value ever exceeded the $10,000 threshold during the year. This simple review can help prevent last-minute surprises when filing deadlines approach. Another tip is to remember that the FBAR reporting requirement is separate from your regular income tax return. Because the filing is done through the Financial Crimes Enforcement Network system rather than the IRS tax form itself, some people forget about it when preparing their taxes. Setting a reminder each year can help ensure that both filings are completed on time. For people who are new immigrants or individuals who recently became U.S. tax residents, learning about these rules early can make a big difference. Many immigrants continue to maintain financial connections with their home countries, which is completely understandable. However, becoming familiar with U.S. reporting requirements helps avoid confusion and potential penalties later on. Financial transparency rules are likely to continue evolving in the coming years as governments strengthen cooperation across borders. As international banking becomes more common, awareness of reporting obligations will remain an important part of financial responsibility for many individuals living in the United States. That's why staying informed through reliable updates and official guidance can be extremely valuable. By understanding the rules, keeping accurate records, and filing required reports on time, individuals can protect themselves from unnecessary penalties and maintain full compliance with U.S. regulations. Once again, Thank you for watching America Immigration Update. If you found this video helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you don't miss future updates that may affect your immigration status, financial responsibilities, or government benefits. Thank you for watching, and we'll see you in the next update.